So, literal lines out the doors for exclusive Pokémon and Parachute drops, a monster bottom line beat, and Wall Street still punished the stock today. Make it make sense. You are listening to Earnings Unscripted. It is May 20, 2026, and today we are unpacking Target, ticker TGT, and their first quarter results. Miro, tell me I am not crazy. These headline numbers actually look great. Right?
No, you are not crazy. On paper, it is a phenomenal quarter. I mean, they pulled in $25.44 billion in revenue, up roughly 6.7% year over year. And adjusted EPS came in at $1.71. That is up over 30% and honestly destroyed analysts' expectations. But the market zeroed in on what it took to get those numbers.
Before we get into exactly what it took, I should just drop our quick reminder that this is not financial advice, just personal opinions and some heavy data reading. But wait, if they beat that badly, why did the stock gap down so hard this morning?
Because Wall Street is terrified of rising labor costs. The stock did gap down around 5% at the open. It trended back up to close down about 4% for the core earnings reaction, but traders are closely watching the SG&A line. Target's selling and administrative expenses crept up. They are pouring hundreds of millions into extra store payroll for nights and weekends just to fix the customer experience.
Which, honestly, as a shopper, is long overdue. They mentioned this new baby concierge test they're doing in a couple hundred stores. They literally have dedicated staff holding the hands of overwhelmed new parents in the baby aisles. It sounds incredibly helpful, but yeah, that has to be brutal on the overhead.
Exactly. I mean, gross margin did improve. It hit 29%, mostly because supply chain logistics are just much cleaner right now. And adjusted operating income was still up 29% to $1.13 billion. So the core business is healthy. But investors look at this high-touch labor model and worry it cannot scale without suffocating long-term profitability.
Especially when they had some easy macro tailwinds this quarter. People had their tax refunds, they had all those viral wellness product launches, and it sounds like the rest of the year might be a completely different story.
Yeah, management is hedging their bets here. The CFO explicitly said they faced the easiest prior year comparison in Q1, and now they're walking into the absolute hardest comparison of the year in Q2, because they have to lap last year's massive Nintendo Switch 2 hardware launch.
Right. You cannot expect people to buy a brand new video game console every single year. All right, let's get into the details on all this.
Yeah, so before we get too deep into the retail floor dynamics, we should probably talk about what is actually happening underneath the GAAP numbers. Because if you look closely, that adjusted operating income growth we just praised is hiding a pretty wild distortion.
Wait, what kind of distortion? I thought they beat the estimates cleanly.
They did on an adjusted basis. But if you look at the raw, unadjusted operating income, it actually fell by almost 23%.
Oh, wow. Down 23? That is a huge gap between adjusted and actual. What is sitting in that gap?
A ghost from last year, basically. In Q1 of last year, they had a $593 million pre-tax gain, just a massive windfall from a credit card interchange fee lawsuit.
Right. Okay.
So they are lapping this huge cash influx. The underlying retail business grew, but the raw cash generation looks optically terrible if you do not strip out that legal settlement.
Okay, that makes perfect sense. It is literally like comparing your normal salary this year to the year you won a scratch-off ticket.
Exactly. And speaking of scratch-off tickets, they actually have a new one buried in this 10K. It has to do with tariffs.
Oh, fun. We are doing international trade law today.
Just a little bit. Back in February, the U.S. Supreme Court ruled that those global Section 122 tariffs under IEEPA, the ones retailers had been complaining about for years, the court ruled those were not actually authorized. And Target explicitly notes they're evaluating how and when they might recover those paid amounts.
You're saying they could get a massive refund check from the government? Highly possible. I mean, they don't quantify it, obviously. The legal unwinding will probably take years. But for a company doing $25 billion in revenue a quarter, clawing back years of illegal tariffs could be a staggering tailwind.
That is actually wild, because normally when we talk about tariffs on the show, it's pure doom and gloom, just margin compression. But here, it might actually be a lifeline.
It might be, which they are going to need given how heavily they are leaning on same-day delivery right now.
Oh, yeah. The digital sales were up almost 9%, but same-day delivery specifically surged 27%. That is all running through that new Target Circle 360 membership program, right?
Yes, which relies entirely on Shipt, their gig worker delivery network. And this brings up the other massive structural risk sitting in the filings. Target warns in very plain language that if regulators force them to reclassify Shipt contractors as actual employees, their digital fulfillment costs will skyrocket.
Jeez, that would instantly kill those delivery margins.
Completely, it evaporates overnight.
And the timing is so tricky because they are literally restructuring their whole physical footprint around this delivery model. Like, they just opened this absolute monster of a receive center down in Houston.
Oh, right, the 25 million carton facility.
Exactly. They built it to warehouse imported seasonal goods upstream so they do not clog up the local stores. They're trying to keep the retail floor pristine for shoppers, but turn the back rooms into high-efficiency fulfillment hubs for the gig drivers.
It's a smart setup. Keep the chaos behind the swinging doors. And Michael Fiddelke, who just took over as CEO in February, he had a quote on the call that I think captures this whole inventory philosophy. He said, let me find it.
Sure.
Okay, here. Quote, "We like our business model when we are needing to chase inventory in the face of stronger than planned sales, much more than when we find ourselves needing to cancel purchase orders."
I mean, yeah, every retailer strongly prefers selling out over marking down clearance racks.
It is a very polite, safe way to say they are deliberately running tight inventory. Flat quarter over quarter, roughly $12.3 billion, they're terrified of over-ordering.
Right, because if you overorder and your labor costs are already inflated from all those extra weekend shifts we talked about, the margins will just crumble. So looking at this incredibly heavy logistical machine they're building, plus wildcard windfalls like the tariff refund, where does this actually leave them heading into the rest of the year?
It leaves them playing, I would say, extreme defense. Like, yes, they did bump their full-year sales growth outlook up to about 4%, but management is genuinely anxious about the rest of the year.
But why? I mean, if the supply chain is finally clicking and the core business is up, what is the big fear right now?
Well, for one, the CFO flat out admitted this current consumer environment was artificially inflated by large Q1 tax refunds. People had extra cash in their pockets. That fades fast. And more immediately, they're walking into an absolutely brutal year-over-year comparison in Q2.
Oh, right, because of the gaming drop. The whole Nintendo Switch 2 hardware launch from last year?
Exactly. You just cannot replicate a once-in-a-cycle console boom. You do not comp against that kind of event. And Jim Lee, the CFO, actually had a remarkably sober quote on the call about it. Let me see. He said, quote, "One quarter does not make a trend yet. That future is paved a quarter at a time."
Okay, so please do not extrapolate our massive beat. That is practically unheard of for corporate guidance.
Usually they're begging you to extrapolate, but here they are actively telling Wall Street to just temper their enthusiasm. Though I will say, giving credit where it is due, the core retail operation looks much healthier under Michael Fiddelke's new CEO tenure. They are executing the tedious parts of retail very well.
Yeah, they are doing the hard logistical work behind the scenes. So the foundation is definitely stronger, but that massive Q2 test is looming.
Yep. We will see how much customer loyalty those new store layouts actually buy them.
All right, I think that is a beautifully realistic note to end on. Enjoy the win today, but brace for the comp tomorrow. Thanks for unpacking the numbers with me, Miro.
Oh, it was a pleasure. Talk to you soon.
If you want these earnings drops to just show up for you, go ahead and follow the podcast. As a quick aside, this show is actually generated with the help of AI to script our dialogue, which is how we can turn 100-page financial filings into a conversation so fast. If you've got a ticker you want us to cover, drop us a note at earningsunscripted@datamadness.ca or find the X link in the show notes. Thanks for hanging out. Catch you next time.
See you then.